Morning, everybody. Welcome to the annual National Accounts Publication 2025 and the revised publications for the quarterly national and international accounts with the time series bringing you up again to Q1 2026. So today's results have a lot of new data for you. So we've got additional returns in from the Tax Authority, from revenue, our annual business surveys. We've completed a lot of our large cases work where we look at consistency between the quarterly and annual returns we get and with other administrative sources. And all that comes together to give us a new time series in our data. You'll see, the guys will take you through this in a moment, but the annual returns have slightly lower growth in 2025, and that lower base means some of the large swings that we had in Q1 25 and the fall again in Q1 26 are slightly smaller in magnitude than we had before, but we'll take you through that in a moment. All the material from today will be up on cso.ie, including the video of the press conference along with the publications. And I'd say if you have any questions, you might pop them into the chat on Teams so I can pick them up during the meeting, and then I'll go to the room at the end for questions. So I'll hand over to Kieran and John now to take you through the national and international accounts.
Thanks, Chris. Morning, everyone. So I'll take us through our national accounts annual 2025. As Chris said, it's the first full look at our annual results for 2025 with the full set of data and our full detailed tables. So we start with the infographic. And so the year-on-year growth, our GDP is up 8% for the year and GNP up 1%. Our domestic indicators then, net national income up 6.2% in the year. Modified GNI or GNR star up 4.7%, and modified domestic demand also up 4.7%. In the release today, we obviously have a lot more detail, and we can look at GDP by three different methods: incomes, producers, and by expenditure. If we look at the domestic elements of those three methods, we see wages are up 1.5%, the domestic sectors are up growth of 2.2%, and personal spending is up 2.6% in the quarter, all leading to that GNI and MDD picture we see. Looking at the more globalised elements of those, profits are up 18.8%. The foreign sectors are up 14.5% in the year, and exports are up 7.5%, and that leads to that GDP figure of 8%. We obviously have a lot more detail, and you can break down into different industries the various types of GDP and all our indicators. So we can see wages, a couple of key findings here: manufacturing wages up 7.5% in the year, and agriculture up 4.3%. Looking at sector growth, again, we can break it down into different sectors. Manufacturing is up 12.1%, and construction is up 7.2%. And then we also have our first breakdown of personal spending, the full detailed classifications, and a couple of findings there: restaurants and hotels up 5.9% in the year, and package holidays up 10.2%. So as Chris mentioned, we had some significant revisions this year. If we compare what our results today with the preliminary estimates based on the sum of 4 quarters, we've revised GDP down from 12.3% to 8%. Our domestic indicator, modified domestic demand, has stayed fairly steady, 4.9 down to 4.7. So you can see that the driver in that revision is value added in the multinational-dominated sectors, with 14.5% down from 25.1%, and net exports 7.5% down from 10.3%. The reason behind those, as Chris mentioned, we get our annual survey data from the large case units. This allows us to see the full picture for the year when their annual outturns come in, and we often have to make adjustments then to previous quarters based on the annual. This happens every year, but I suppose it was exceptional this year. The revisions were particularly large, and I guess these companies are part of large complex global supply chains, and this year in particular there was maybe a lot of uncertainty around international trade, and particularly with the US, so the revisions we saw were large. We also get our latest revenue data: corporation tax, income tax, payroll, and our structural business survey data, the Census of Industrial Production, annual service inquiry, and Prodcom. We also include annual revisions to CSO's balance of payments and tourism surveys. And then we also update the reference year to 2024, which of course changes the weighting of that constant time series. We like to include a couple of methodological revisions every year as well, and this year included in those revisions were some changes to compensation of employees, where we included PRSA employer contribution data based on updated data from our pension authority, and we also improved our exhaustiveness estimates that try to estimate the value of the hidden economy. In the time series, of annual GDP and GNI star. I think if we focus on the dark blue, the GDP, we can see the volatility in that series since we came out of COVID in 2020, 2021, whereas the green bar shows that the GNI star shows that the domestic economy has had consistent growth over the period. So in today's annual release, we have our first view of our modified GNI, our domestic indicator, and we can see we walk from GDP of 602.4 billion. We adjust for the profit flows out of the country, these to the multinational sector at 173 billion, and that gives us a GNP of 429.4 billion. Small adjustment for EU taxes and subsidies gives us our GNI figure of 430 billion. And then we make our globalised adjustments. That's taking out depreciation of large IP, depreciation of aircraft leasing, and any adjustments for the flows around redomiciled PLCs. And that gives us our modified GNI SAR of 334 billion for 2025. Similarly, it's also our first estimate of net national income. Again, the advantage of net national income is it's an unadjusted figure, part of the system of national accounts, so it does allow for international comparison. We have GNI of 430 billion. We take away all the depreciation in the economy and have NNI then of 303.8 billion. Because it is unadjusted for any globalised effects, it does seem. I think John's presentation later has some detail on their activity over the last number of years. One of the main uses of GDP, of course, is to use it as the denominator in a ratio for international comparisons to see how we're getting on with health spending, education spending, etc. And I suppose this just shows that modified GNI maybe allows us to use to estimate a ratio more specific for our domestic economy. So we see the difference it can make. Debt to GDP is 63% using modified GNI, whereas it's 35% using GDP. Similarly, the general government balance, we have a surplus of 3.4% of modified GNI, but only 1.9% of GDP. And I guess it's important to understand the context of the metric you're comparing when choosing a denominator. If we look then at our suite of domestic indicators, modified GNI, MDD and NNI over the years, we can see there's different levels there. GNI SAR is higher than the other two, but the general trend since we introduced these in 2016 has been to 3. Another way of looking at them is as a percentage of GDP, and we can see that in 2025, the domestic economy makes up, based on our indicators, the domestic economy makes up between 49 and 55% of GDP in the year. It's higher than it was in 2022, but not at the levels of back 2017, where it was between 56 and 65% of GDP. Just quickly, I guess this again explains what's driving our GDP growth. The dark blue, the foreign-owned multinational dominated sectors, it's a very similar picture to our GDP time series where you see that volatility over the years, whereas the domestic sectors again just show consistent growth since COVID pandemic 2021. As I mentioned earlier, we have a lot more detail in the annual report today, and we get to look at GDP by different measures and look at it by producers. We can see for the total economy, intermediate consumption or costs make up just over 50% of output, and but then this isn't the same over different sectors, with some sectors like construction and information communication and finance and insurance activities having more costs, while others, professional admin, support services, public admin, education and health, have less costs as part of their output. Looking at GDP by incomes, we can see the labour input into the GVA, and compensation employees or wages are 29% of GVA, with profits at 49% and consumption of fixed capital of 22%. Again, we have a lot more detail of this in today's publication. Looking at expenditure, I think if we look at what's driving growth, the 8% GDP growth in 2025, we can see it's the light green net exports and the. But when we strip out those globalised elements, net exports and growth in large IP, we see the reduced modified domestic demand, but still have growth in all three parts of that. If we look at that in more detail, we can see that, yeah, there's growth in government expenditure, personal expenditure, and modified GFCF is the largest driver in today's results. Again, this just shows I suppose the impact of how it's the globalized element, the net exports and others driving GDP growth this year. Looking in more detail at our personal consumption, we can see that our result of around over 2% puts us to really just above average for the EU. When we look in more detail in that, we see there was growth in personal spending in health, restaurants, hotels, household goods and maintenance, recreation, sport and culture, whereas we saw a decline in spending in education, clothing and footwear, alcohol and tobacco, and insurance and finance. Again, we've more detail on this in today's publication. Capital formation, we see the largest growth was in research and development, but that is that globalised large IP. Elsewhere, we see the growth we've been talking about all year in software and other machinery and equipment, really driven by that data centres and associated activities. But we also saw growth in the construction of dwellings, transfer costs and other building and construction, with a small decline in the expenditure on roads. We produce an information note today as part of our A&A, and Brian Stanley will be going through that in our seminar after, where we break down the GFCF and building construction in more detail. So that's available to look at. Looking at prices then, when we look at GDP in current prices up 7.2%, and in constant prices up 8%, that gives an implied price deflator for GDP of minus 0.7%. And then for personal consumption, current prices up 4.4%, constant prices up 2.6%, and that gives an implied deflator of 1.8%. And I suppose this year in particular, we're starting to get concerned about inflation again. And today's seminar, we also have a discussion on inflation. So Anthony Dawson will be along to explain all that. So the 2025 annual summary, GDP up 8%, GNP up 1%, GNI star up 4.7% and NNI up 6.2%. On the output side, industries up 11.9%, information and communication up 14.8%, construction up 7.2%, distribution, transport, hotels and restaurants up 2.1%, and professional and admin services up 1.9%. The multinational dominated sectors up 14.5%, and the non-multinational dominated sectors up 2.2%. On the expenditure side, PCE is up 2.6%, government expenditure up 3.2%, investment up 8.4%, but modified investment up 11.3%, net exports up 5.2 billion, final domestic demand then up 14.2%, and modified domestic demand up 4.7%. The net factor outflows of 174.9 billion, up from 134.2 billion in 2024, which gives us that reduced GNP figure of 1%. I'll now take us through the revised Q1 2026 figures. So we revise our GDP figure. Now it's down 7% quarter on quarter, seasonally adjusted, with GNP up 6.8% and modified domestic demand up 0.3%. The main drivers of that GDP figure are the decrease in industry of 12% and information and communications 2%, with a more mixed picture in the domestic side. Driving our MDD down, we can see personal consumption's up 0.8%, government expenditure up 0.3%, investment down 0.6%, but exports down 8.4%, which is again driving the GDP result. Over time, we can see a lot of volatility again in our GDP figure at minus 7% this year, whereas our MDD again is more steady with more modest growth in the last few quarters. So this is the third estimate of GDP for Q1 2026. Originally, our preliminary or flash estimate was minus 2%. We then revised that to minus 12.1% at our T plus 60. And then today we've revised that further to minus 7%. So as we've explained, I suppose the latest estimate includes all the annual data updates, which has a large change to 2025, which will have a base effect then as we've reduced the level of 2025. that has a base effect into quarter 1 2026. We also use a new base year for constant price data, so changing the base year from 2023 to 2024 will change the weighting, which has an impact on the constant time series. And then we also review our annual seasonal adjustment. The changes of the 2 points above in the base and the base year can affect seasonal adjustment and cause us to make adjustments to our model there, all leading to changes in the final result. We also have an extra 30 days, I suppose, to pull in all the data and fully understand fully understand the full picture and get all the data in there to make sure how we have the most accurate possible result. When we look then at where we are in our EU, obviously the GDP there over on the left, -7 is an outlier across the continent, but if we use MDD, we'd see that we'd be there in the middle around the average. So the quarterly summary, GDP -7%. On the output side, industry -12%, information and communication -2%, construction -4.3%, and distribution, transport, hotels and restaurants -0.6%. The multinational dominated sectors are -7.5%, and the non-multinational dominated sectors up 1.1%. On the expenditure side, PCE is up 0.8%, government expenditure up 0.3%, investment down 0.6%, with modified investment down 0.9%, net exports down 37.4% at 22.8 billion, with final domestic demand 0.2% and modified domestic demand 0.3%. So the net factor outflows minus almost 19 billion there, down from 36 billion in quarter 4 2025, leads to that increased GNP number of 6.8%, with compensation employees or wages down 2.3%. So thanks. I'll pass you over to John now for international accounts.
Thanks, Kieran. So now I'd like to go through the international accounts. So we're looking at data revisions across the time period from Q1 23 to Q1 26. We have our updated annual data series for redomiciled PLCs and CA Star, our modified current account balance. And we have our continued series on foreign controlled corporations and the US current account, which I'll touch on today as well. Just to start with, what has changed since we published is down a little over 500 million, and the net income is up a little over 700 million. And these all combine to give us a final current account balance of 17.9 billion, which is up just 442 million on our preliminary figure. Where we really see the changes are in the revisions to 23, 24 and 25. So if we start here with the merchandise, we can see there was no change in 23, with actually zero change. In 24, we have a small increase of 1.5 billion across the year. But in 25, we see a reduction of 32.5 billion across the year, going from 230 billion to 198 billion. And this largely driven by valuation changes across the year. Looking at our services, we see smaller changes, with 23 balance decreased by 1.9 billion, the 24 overall balance decreased by 2.8 billion, and the 25 balance increased by 1.9 billion. Looking at our net income balance, we see slightly larger changes in the earlier years, with 23 increasing by 7.3 billion, 24 by 6.2, but the 25 balance has increased by 26.8 billion, and this largely reflects that reduction in the net merchandise. And these all combined gives the overall revisions to the current account balance of plus 5.4 billion in 23, bringing us to 42.3 billion, plus 4.8 billion in 24, bringing us to 95.8 billion, and minus 3.4 billion in 25, bringing us to 48.3 billion. We've also updated our redomiciled PLCs chapter, as Kieran mentioned. So redomiciled PLCs are companies that move their head offices to Ireland in what can also be known as a corporate inversion. The inflows of income for these companies have an impact on our net factor flows, and so we show these separately for analysis. We can see here the level of redomiciled PLC income and their impact on the overall net factor flows. So there has been some volatility in the last couple of years, with populations changing, with an increase from 2020 to 21, a decrease into 22, an increase into 23. 24 stayed at fairly similar levels, while 25 increased again. And these are all reflected in the graph here. It's the gap between the green line and the blue line that shows the difference between the net factor flows as they are and how they would be without the redomiciled PLC income. They have a large impact on our direct investment abroad. So we can see here that right across the years, they make up roughly 50% of our total direct investment abroad, with the redom foreign direct investment abroad of 626 billion in 2025. Now to look at our modified current account, or CA star. This is a measure that removes some of the globalisation impacts of M&Es, and it is designed to be consistent in approach to GNI star and modified domestic demand. So we can see here that the blue line is our current account balance, which is much more volatile than the smoother green line, which is our CA star. So we can see this in 23, CA star is 5.5 billion, which is 36.9 billion lower than the current account balance. In 24, it's 26.9 billion, which is 69 billion lower than the current account balance. And in 25, it's 24.3 billion, which is 24 lower than the current account balance. Looking at revisions to this, we see relatively small revisions. Within 23, it's decreased by 0.7 billion to that 5.5 billion. And in 24, it's increased by 1.8 billion to that 26.9 billion. And then looking at it as a percent of GDP, this graph looks quite volatile, but the scale is quite low. So we can see that, for example, in 24, CA star as a percentage of GDP is 4.8% compared to the current account balance is 17% of GDP. And in 25, it's 4% compared to the current account balance is 8% of GDP. This graph, which is available on our website, so you can look at it in more detail, shows the adjustments as we move from the current account balance to CA star. And we can see that the adjustments have changed quite a lot over the years. Within 23, a reduction of 36.9 billion to get us to CA star. In 24, it's 68.9 billion. And in 25, it's 24 billion. And these are mostly due to changes in levels of IP imports and exports across the years, which is also what adds to the volatility of our current account balance. We now look at foreign control corporations and their impact. With the large levels of multinational activity in Ireland, the impact of these foreign control corporations is significant. And one area they impact is the net international investment position. So to help with analysis, we've begun looking at the net IIP by ownership to show this impact. And we use the ultimate controlling parent to determine ownership. So we have two tables showing the net IIP by ownership. So one is by reference sector, which describes the type of company, whether it's a non-financial company or different types of financial companies. And one by functional category, which describes whether it's direct investment or portfolio investment and so on. So looking at our basic split between foreign owned and Irish owned, we can see here the net IIP, which is the yellow line, in Q1 26 was minus 341.6 billion. But we see an interesting effect when we split into foreign and domestic, because the foreign impact is minus 524.8 billion, while the domestic impact is actually a positive 183.2 billion. We've continued with producing our US current account, and you can see here the evolution of it over the last few years. In particular, you can see that change from 20 to 21, where we saw some geographic movements where income started to flow directly to the US and royalties started coming directly from the US. So it's important to note that the levels didn't change as much as the geography where these things are coming from are going to changed. So looking across the last couple of years, we can see that our merchandise balance went from 65 billion in 24 to 97 billion in 25, while our services balance went from minus 160 billion in 24 to minus 203 billion in 25. Income moved from minus 62 billion in 24 to minus 99 billion in 25. And these all combined to give us our current account balance with the US of minus 157 billion in 24 and minus 206 billion in 25. We also produce a net international investment position directly with the US. We can see here that it's very strongly positive, and this is largely driven by investment funds in Ireland, where the assets they hold tend to be more in the US than we have US people owning shares in our investment funds. So we have here these diagrams that I think show a good picture of how the whole current account hangs together. So it shows money flow from left to right. So on the left, we can see money flowing into Ireland from the UK, the US, EMU countries, which are countries in the Eurozone, and other countries. And this is the proceeds from exports of goods and services and income inflows. On the right, we see money flowing out of Ireland to the UK, US, EMU countries and other. And this is the funding of imports of goods and services and the income outflows, like the outflow of multinational profits. And the size of each piece gives the relative contribution. And the difference between the sides gives the current account balance. So we see that the inflows are fairly well geographically spread, while a big proportion of the outflows are going to the US. And this difference between inflows and outflows reflects the large negative current account balance with the US. Looking at first just merchandise, on the left, again, we can see that diverse spread of our exports going right across geographically. And on the right, we see the much lower level of imports. And the difference between these sides reflects the large merchandise surplus. On services, this looks much more balanced, but we have to note that the left reflects exports of services, for example, computer services, which have been growing steadily and strongly over the last few years. And on the right, we reflect imports of services, which supports the production not only of those services, but also goods, for example, royalty imports. We can see again that the exports are quite well geographically spread, whereas on the right, we have quite large levels of imports from the US, largely driven by those royalty imports. And then looking at our income inflows and outflows, you can see the lower levels of income inflows on the left and the much larger levels of income outflows on the right. And these are largely the outflows of profits generated by multinationals. And you can note again the large outflows to the US as seen in the US current account. So to summarise the 3 years, we have our merchandise surplus going from 157 billion in 23 to 177 billion in 24, up to 198 billion in 25. The services balance moves from 17 billion in 23 to 57 billion in 24, down to 28 billion in 25, with that largely driven by differences in IP imports and exports across the 3 years. While our net income outflows of 131 billion in 23 and 138 billion in 24 rose to 178 billion in 25, again reflecting that increased merchandise surplus in 25. These all combine to give us a current account balance of 42.3 billion in 23, 95.8 billion in 24 and 48.3 billion in 25, with the corresponding CA star figures of 5.5 billion, 26.9 billion and 24.3 billion. So now I'd like to pass you back to Chris to summarise the results.
Thanks, John. So for us, we're looking at a large growth rate in 2025, an annual result there, not quite as big as what we thought from the sum of the 4 quarters, but we ended up at 8% there. And our deglobalised measures, GNI Star and MDD, both coming out, both trying to measure different things, but both coming out at 4.7%. Some of the more domestic-orientated measures you tend to look at, consumption is finishing up at 2.6. The domestic sector is 2.2, and wages 1.5%. So that's telling us there's a little bit from the M&Es contributing towards those deglobalised measures at 4.7%, both for MDD and for GNI Star.